Welcome everyone to Vested Interest. This is Shane back again for the stock pick of the day video. It is September 11th. We are going to take a look at a insurance company out of the financial sector, Radian. Before we get to the video, if you do me a big favor, hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. A lot of you out there watching the videos are not subscribed, and you're watching the videos and tuning in, so it leads me to believe you are enjoying the videos. So go ahead and hit that subscribe button. Come on out of the shadows and join us here in the Vested Interest community. It really does help out a small YouTube channel like mine. Make sure you click that notification bell so you're notified whenever we put out any new content. I do these stock pick of the day series videos Monday through Thursday whenever the market is open. I also do subscriber and viewer requests. So if you have a company you'd like me to cover in the stock pick of the day series, go ahead and drop it down below in the comment section and let me know what you think. And drop a comment down below and let me know what you think of the video as well. Again, doing all that really does help out a small YouTube channel like me. And a special thank you to all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Now, this is the Vested Interest Stock Screener. This is how we are going to run through the video. It's also how I look at a company on a high level to see if I'm interested in adding into my watch list. There are thousands of stocks out there in the market, like Radian. I've never looked at it. So this is my initial screener where I can see if I'm interested at all in doing a deeper dive. It's a quick run through of a company to see if, like I said, it meets some initial criteria. And then if it does meet 5 of 8, in this case, since it's a financial company, we're going to throw in price to book. It must meet 6 of 9, and then it would go on my watch list. And then I would do more of a deep dive into the financials, look at stuff like margins. Are they growing over time? Is their revenue growing over time? Are they expanding margins? Are they paying down debt? Do they have more assets over liabilities? What does their PEG ratio looks like? A lot of good information on the balance sheet and income statements. Are they paying down debt, for example, that you should be looking at if you are investing in individual companies. And if you don't want to do that kind of deep dive, you should probably stick to ETFs or index funds. Nothing wrong with that. Warren Buffett actually recommends that for most people, and he would recommend the S&P 500. So something like VOO, which is a Vanguard S&P 500 ETF. SPY is another one. There are several S&P 500 tracking ETFs out there, and that's what you should look at if you are looking for something to set it and forget it. I have VTI, which is the total United States stock market. I also have SCHD. Seems to be a pretty popular one out there. I like it for dividend growth and a nice starting dividend yield, usually around 3.4 to 3.6%. So there's a couple there that you might want to take a look at if you're looking at something in the ETF range. But like I said, Warren Buffett would recommend something that tracks the S&P 500 for most casual investors. Now back to Radian. You can check them out at www.radian.com. That's www.radian.com. That is their homepage where I pulled this information from. And as you can see, they really focus around the mortgage industry, title insurance, real estate valuations, asset management services. They cater to realtors with their mortgage services, their title insurance. Really, that's what they're looking at. Title services like title insurance, valuation services. So companies might come to them like banks that are looking to value a house, or maybe your realtor might come and say, hey, what does this house look like for valuation purposes? Asset management services. So if you need an asset manager, there you go. Real estate agent services, right? If you're a real estate agent, you're probably using some service like Radian, if not Radian, to set up your title services at closing, mortgage insurance, mortgage risks, mortgage services, and corresponding lending. So they deal with a lot of lenders as well. So it's an insurance company with, some almost ties to the banking industry as well, but really focused around the real estate and the mortgage industry. That's really where their bread and butter seems to be. Now, the reason we are taking a look at them, down 2.82% on the day, we are talking about Radian Group, ticker RDN. Again, this is out of the financial sector here. This is an insurance company. Closed the day out at $33.78. 52-week range as low as $24.56, as high as $37.86. So really, even with the drop here, they are still a little closer to their 52-week high than their 52-week low. They are not within 15% of their 52-week low. Not quite. They need to come down a little bit more. Market cap of 5.081 billion. So they are a small cap company here, a beta of 1.05. So they are slightly more volatile than the overall market. That's what beta means. It's the volatility of the market. PE is price to earnings ratio, $8.80. Very low, but really for insurance companies and banks, financial companies, we should be looking at price to book, which we will here in a second. EPS, earnings per share, $3.84 per share. Nice there. Earnings date, October 30th through November 4th. Sometime in that window, they'll have another earnings date, so tune back in for that if you're interested. I don't cover earnings date. I just mean tune back into their earnings date if you're interested in a Radian company. Forward dividend is 98 cents. I believe they're a quarterly payer here. So divide by 4, though we will see that here towards the end of the video. So just hold tight. Yield 2.82%. Nice starting dividend yield on this one. Ex-dividend date August 26, 2024. Looks like they're going to pay out. Well, it looks like they paid out today. So I don't know why they would drop on their dividend payout date, other than typically they might drop a little bit by that payout. Usually that's on the ex-dividend date, not the day they pay it out. But they dropped 2.82% on the day. Maybe some negative news. Might want to look at that as well. 1-year target, at least according to Yahoo Finance, where I pulled this information from. I'm not affiliated with Yahoo Finance. $35.93. So they see it not quite going back up to its 52-week high, but they do see some price appreciation as far as where it currently sits to what they're projecting. Let's jump over here to the right. We're going to take a look at dividend yield theory. To do that, we look at their 5-year dividend yield average, and I think they just have 5 years of dividend raises. So they're just right at that sweet spot where they have enough time where we can look at this. They have a 5-year average of 2.53%. We compare that to the current 2.82%, or over here where it says forward, same number, 2.82%. And since this is higher than their 5-year average, that speaks to some undervaluation on this company. Very low payout ratio here. Note that 24.48%, extremely low payout ratio. I like anything under 75%, so that is very low compared to what I typically look at, or probably what the average in my portfolio is. Again, I like it even lower if you can get it, but most companies don't have a low payout ratio like that. So we looked at the dividend date. Now price to book, we're going to jump down here. And again, if you use price to book for financial companies, I use 1 fair valued, anything under 1 undervalued, anything over 1 overvalued. So as you can see, the current 1.17% would, or 1.17 would be slightly overvalued by price to book. You could have gotten it cheaper here last year at times, just under at 0.97, just under at 0.94. Now this is not egregiously over 1, but it is over 1, and it is one of the highest over the last year, right? So right now it is about the most expensive it has been over the last year. So you maybe can wait for more of a pullback. Looks like it was pulling back a little bit more in the after hours. Maybe this one drops into the 32 or below range. It's a little more attractive. And I imagine a company like this, especially dealing with mortgages, mortgage insurance, title insurance, they are going to be impacted by rate cuts and people buying houses, right? The more people going out and buying houses, the better a company like this probably does. And also around building trends, right? If we're building more houses, obviously you're going to need stuff like title insurance and mortgage insurance and valuations on houses. So those would be 2 industries: the financial sector as far as rates going up and down, and the building sector as far as house building in general. Now we're going to jump down to free cash flow. We want growing free cash flow over time. Typically, if a company has growing free cash flow and they pay a dividend, they raise that dividend along with it. Going back to 2021 here, you can see $544 million in free cash flow. 2022 down to $370 million, so a bit of a drop there. 2023 back up to $513, but down from 2021 still. And so far in the trailing 12 months, only $175 million. So we're going to have to wait to see how the rest of the year shakes out, because part of this trailing 12 months is actually 2023 numbers still, right? But they are repurchasing shares as well. $399 million in 2021, slightly up to $400 million. So even though there was a drop, this doesn't quite account for that drop, even though they increased their repurchase of shares, right? So just a slight increase, but a bigger drop in free cash flow. So it definitely is up and down on the free cash flow. $133 million in 2023. Looks like they're continuing that trend over the last trailing 12 months. Already bought back more shares than what they did last year. So that definitely means that part of this repurchase is this year, not just all of last year. So again, we'll have to wait to see how the numbers shake out for the rest of 2024, but it looks like it might be a similar year to 2022. Now, jumping over to stockanalysis.com, another site that I like to go to for information, I always recommend that you look at more than one site for information so you can make sure that the information you are getting is accurate and up to date. And as you can see here, price targets for this company were last updated August 5th. So we're about a month behind on this, and that is why I recommend more than one source. Again, some of these companies are not updating their information on a daily, weekly, or even monthly basis, so some of it might be a little outdated. And sometimes they're just wrong. It does happen, right? These companies are run by humans. These websites are run by humans, and humans make mistakes. It's just the nature of being a human. The 5 analysts that have taken a look at this, they do call it a consensus buy. If you were to go to stockanalysis.com's webpage, you'd be able to click on each one of these tabs and see how many might call it a strong sell, a hold, a buy, and a strong buy. I imagine some are calling it a hold, some are calling it a buy, maybe even someone calling it a sell, because it is right on the edge of the hold and buy. And there only are 5 analysts, so you might have 3 calling it a hold, 2 calling it a buy. That would put it pretty close there too. Or you could have 1 calling it a sell, 2 calling it a hold, 2 calling it a buy. Same thing. You'd have it somewhere in there. So you might want to go to their homepage and see how those shake out. Though I do like more than 5 analysts. Usually you get double digits with analysts. That really gives you kind of an idea. And as far as analysts, again, they are just people. They're just like you and me. Doesn't mean they're right. Doesn't mean they're wrong. I just look at it like a range, right? Maybe the low is $31.50. Maybe the high is $40. So I look at it as a range of people's opinions. That's what I look at this range as. They do have a low estimate of $31.50. That would be a 6.75% decrease, and that would be a better buy-in price. You'd be closer to a 15% of a 52-week low. That would put you probably under 1 as far as price to book as well. Average estimate of $35.90, pretty close to what we saw with Yahoo Finance on the previous page. That would be a 6.28% increase. High estimate of $40 would be a 18.41% increase. All the while, you could collect that 2.8% dividend yield if you were to buy them now. Now, clicking on statistics would push us over here to this information. There's a lot of information under statistics, but financial efficiency is one of the areas I like to look at to see how well a company is reinvesting its capital back into itself. I like 10% or better for return on equity and return on invested capital. Return on equity at 13.95% beats the metric of 10% I'm looking for. But return on invested capital is a little low at 9.07%. It will not get a check, but I will tell you, it's close enough. If I was interested in this company, I would probably go ahead at 9.07% and give this one a check. Because it's just close enough. I mean, 10%, 9.07, you're talking about 9 or 0.93% off. So it's not egregiously low. If it was a 3% or 5% even, then yeah, I would say that's too low. I'm not going to give it a check, but I would not be upset if you decided to do so. EPS, I like 5% or better projected over the next 5 years. They do not have it listed. They do not have revenue growth either. This is not a metric I look at until I get into the deep dive of a company. I do include it here because I like to see growing revenue over time. The faster, the better. Now, jumping back over to their dividend history, again, quarterly payer here, payout ratio, again, 25.53%, very low. I like anything under 75%. Dividend growth, extremely fast, very high, single digits, almost double digits, 9.71% dividend growth. 4 years, they're saying, I think it's actually in the 5th year now, so 4 years in their past. That's why we've got 5 years to look at. Buyback yield of 3.29%, so when they are buying back shares, they're doing it efficiently. That's good to see. I like companies pulling shares out of the market. It makes you as a shareholder more of a shareholder, even if you don't buy more of the stock. Shareholder yield of 6.2%, very good numbers overall. Very high shareholder yield. That's very good. You want positive for both of these numbers. Now, dividend history, again, going back to February 2022, you can see here they were paying 20 cents in dividends. Jumped it up here in February 2023 to 22 cents and fractions of a penny. Jumped it up again February 2024 here. Most recent raise was up to 24 cents and some fractions of a penny. I would say again in 2025, the raise will probably happen in February. They do have a payout on March, June, September, December, like most companies do. So their payout is right along with most of the market out there. Now back to the screener. Understand the business. That's where we start. Check there. We always start there. Every business, unless it's extremely hard to understand. Maybe you haven't bought a house, so you don't understand what mortgage insurance is or title insurance and that sort of thing. I bought a couple different houses, so I've signed closing documents, and they always go over the title insurance, mortgage insurance, that sort of thing. So I'm aware of that. I see my mortgage insurance every month on my payment, little tab there, the amount that I'm paying. So I'm aware of what those things are. Again, if you haven't bought a house, maybe you don't understand that, and maybe that you wouldn't understand the business. Growing free cash flow over the last 4 years, we were up and down there, right? So we're not going to give them a check there. Growing dividend, yes. High single digits, 9%, very nice. Dividend payout ratio, 25%, very low. Dividend yield theory says it's potentially undervalued. It is not within 15% of a 52-week low, so you might want to wait for it to drop a little bit more. Return on invested capital and return on equity. Return on equity looked good, but return on invested capital was only at 9.07%. So I'm not going to give them a check. But again, if you were interested in this company and you said 9% is close enough for you and wanted to put a check there, that would give them the 5, not quite the 6 you need. Return on invested capital, return on equity, 10%. Nope. It didn't get we already covered that. Didn't get both of them. And earnings per share over 5% was not listed. Now, price to book, same thing. It was 1.17%. So if you say 1.17% is close enough to you and you gave them a check there and wanted to get it to 6 of 9 so you could do more of a deep dive, I'm fine with that. But for me, 1, 2, 3, 4, it wouldn't quite make it onto my watch list to do more of a deep dive into the company. It does look like an interesting company. I will say it is going to be impacted by rates. It is going to be impacted by the consumer out there. When people are buying houses, rates are low. A lot of houses are being built. So the construction industry as well, if they're building a lot of houses and people are filling them up, this might be a company that is positively impacted. Well, that is it for this one. Running a little long here. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. And drop a comment down below. Let me know what you think of the videos. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Radian you'd like me to cover, go ahead and drop it in the comment section and let me know what you think of Radian. Is it in your portfolio? Is it one you're watching? Is it one maybe you are selling? And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. I hope you have a great week, and we'll see you in the next one. Hey, I'm not a financial advisor. You can read through the rest of this. I'm definitely not your financial advisor, so make sure you are doing your own research before you buy any stocks, and you can lose money in the market.